Okay, so I just wanted to take out a little time to go over a call option that I actually placed today on Microsoft and explain why um, option plays are good to have in your arsenal. They offer a lot of flexibility, and you can really take profit from the market, whether it's going up, down, or even trading sideways. A lot of people use options to hedge against potential drops in their stocks. Options can also help you protect your portfolio. So it's almost like an insurance. You know what I mean? Um, so during I'm sure you see how the market has been going. We've had a lot of downtrends lately for obvious reasons. But so you might see your whole portfolio red, right? But just know that while you see all of these stocks going down, there are people out here that's making money off of that the whole time. And they are doing it. One way they're doing it is by actually buying put options, right? So a put option is you're basically betting on a stock to go down, right? A call option is betting on a stock to go up. Um, a lot of people also um, y- trade stock options because it offers leverage. Instead of spending a lot of money on, let's say, to buy shares, you can control that same stock for a fraction of the cost, in most cases. And that means potential higher returns on your investment with less capital that you actually have to invest upfront, right? So I'll give you this example because I actually entered a Microsoft call today, right? And I did a $380 call that's expiring tomorrow. So it's a weekly option. The ask price for it was around $255 at the time of purchase. Um, and when you look at a call option or you look at a put option, it's not going to say $255. It said $2.55. But each contract covers 100 shares of stock. So when you see that $2.55, you multiply that times 100 to get the actual premium or the actual price of the actual contract. So I saw $2.55 and I actually paid $255 per contract, right? So at the time that I entered this trade, if you can see where I have my entry point, it was at around the stock was at around $376.79, right? So that's even if you look at that, right? The stock price is at 376.79. I bought my contract for $255. That's $121.79 less than it would have cost me, excuse me, to actually buy a share of that stock. Um, or it cost me less to buy that than somebody that would have bought shares at the same time, right? So Microsoft traded as high as $387.97 today, which was roughly around maybe 3.44 to 3.50 percent return on the investment today if you had bought it at its lowest point and sold it at its highest point, right? So if you purchased Microsoft today at the lowest that it was, right, which I believe is around $372 at some point, and sold it at its highest point, right, you would have gotten a return of around 3.44 or between 3.44 and 3.50 percent return on your actual investment, right? So meanwhile, I purchased a call option on that same stock, right? And I bought it close to the lowest point that it was today. The lowest point was around 372. It got in around 376, 377. And actually, I took profits on 233% return on my actual investment. Um, and I did that utilizing the exact same price action that a person that has shares or who bought shares were looking at. We looked at the same thing, you know. Um, um, so um, this means that if even if you had bought one contract today, right, for $255, at some point you would have had the opportunity to take around $594.15 or better in profits, right? And that's crazy because $594 is almost double the cost of the actual shares, right? At 376. Um, and that's crazy. And I did that. You would have done that with less money than it cost to actually buy the shares today, right? And when trading options, right, we take advantage of price action, right? And you have to understand what price action actually is. And it's basically how stock price moves over time. So to determine those things, and I'm not going to go too deep into that, but just to kind of like give a little summary, for people that are traders, consider themselves traders, a few of the things that you might look at to when you're considering price action on a stock is support and resistance levels, candlesticks, chart patterns, and trends. You want to know if a stock is trending up or trending down, because at the end of the day, those movements are what you would use to try to predict what would happen next. And options let you profit from those predictions in different ways. So if the price action appears to be bullish, then you could safely, you could feel more confident that the stock is going to go up. And at that point, a trader might buy a call option because that's their expectation. And on the other hand, if if the price action is bearish, then that means you're expecting the stock to actually go down. A trader might buy a put option, right? Because that's their expectation. And this way, if price moves in any direction, a trader can take profit from it, right? And that's why some people say, hey, you can get money out of the market no matter which way it's going. So um, on green days, I know it seems like everyone's an expert, right? Everything's going up. And then on the red days, everybody panic. Oh my God, the market is crashing. Get out. This is why I don't trade, blah, blah, blah. Right. And one of the reasons they have that perspective is because they probably only know one way to get money out of the market, and that's by buying shares, right? And they don't tap into the other ways that you could take advantage of price action in the market, right? Whether it's going up or down. So option trading is one of those ways. And that's why during this time where the market is crashing, you had some people clapping and enjoying life the whole time because the market was going down. They were expecting it to go down. So they were doing put options and making profits the whole way down. And now this week, since the market has kind of like reversed and started going up, guess what they're doing? They're buying call options because now the market is going up. So they're riding the wave. They're riding that momentum, right? And that's one of the things that I took advantage of today. Um, and I highlighted it. This yellow box that you see is just because I'm using a 15-minute chart right here. I just wanted to section off the price action for today specifically, right? And we got in here, so we had a great entry point, and it basically just went up from there. Like I believe the market opened at 9:30 Eastern time, and by 9:45, that stock had went up somewhere between $5 to $6 already after we entered and bought the $380 call. So it was almost at it probably hit 380 within the first 15 to 30 minutes of the market being open. And in the options world, a $6 move, money. Money, 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 right? Um, that's why when you look at, let me show you. Right. Okay. Mhm. All right. So it's Microsoft today, right? And look, $12.94. That was around the high of the day, right? And as you can see, it went up 3.46 percent, right? $12.94 price move to the upside, right? And we had we entered 1 second. Second. Okay, there we go. So as you can see, at 9:43, I entered my $380 call at $2.55. When I share calls like this with such a short expiration date, because that contract expires tomorrow. So it's always a risk, right? When you buy an option play that expires that close. Because if for some reason that stock went down, I wouldn't have had a lot of time for it to actually recover, right? So I like to, give my people a heads up that this play was very risky. I don't care how confident you are. The market is the market. So I saw everything that I liked that confirmed that it was the right play, but at the same time, there are no guarantees, and I would like to give people a heads up like that so that they can actually manage their risk, right? And they can know the risk. So that risk, you have to be careful. So okay, let's see. All right. So same screenshot, right? As you can see, the stock price went up 12.94 and it was a 3%, 3.5% increase return. My option play was up 233% at the same time, right? Off of that same $12.94 move to the upside, where it gave shareholders 3% increase on the value of their stock at that time. I took 233% off of it, right? And that's one of the benefits of trading options, right? Is it more risky than holding shares? Absolutely, right? But can you turn a bigger profit? Can you maximize your gains, right, with less money than it would actually cost to actually own shares of some of these companies? Absolutely, right? And this is the proof of that. So I just wanted to go over that briefly. Hope I didn't take up too much of your time, but I just wanted to show like the benefits of trading options, right? And it's worth studying. It's worth looking into, right? And it takes some studying. It takes some technical analysis. But the fundamentals and the basics are of you knowing, like, even if you listen to me right now, you know that, hey, if I think that a stock is going to go up, I should look at call options. If I think that a stock is going down, I should look at put options. You start there, right? And you just add on to your knowledge from that point, right? But I just wanted to make a quick little video, man, to go over that. And for my people that are in the group, um feel free to reach out, to ask, any questions. We always here for it. So y'all have a good one.